Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We are diving deep into a stack of sources capturing the manic, frantic pace of global financial headlines from this morning, October 13th. The defining feature of this market right now is pure, unadulterated whiplash. It seems entirely driven by geopolitical threats and then, the social media posts that immediately contradict them.
That whiplash is exactly the story we need to unpack, isn't it? Our mission today is pretty simple. Connect the dots in this really complex landscape where markets were just whipped back and forth by single statements.
Brutal statements.
We're looking at a week that saw, roughly $2 trillion erased from U.S. equity value just on Friday.
Huge number.
They're only to see U.S. stock futures, the Dow, S&P 500, NASDAQ jump 1%, almost 1.9% this morning. So we really need to understand what this massive reversal means, especially as critical Q3 earnings kick off and, global instability keeps spiking.
It really is staggering. The fate of trillions resting on, rhetoric. This rebound this morning is the main headline, obviously, following that brutal Friday rout. I think it was the largest drop for the S&P 500 since April.
That sounds right. Yeah.
And reports coming out from Yahoo Finance and Bloomberg, they confirm this movement is almost entirely dictated by the flare-up and then the sort of sudden de-escalation in the U.S.-China trade situation.
Okay, let's lay out the timeline for you just so it's clear. The fear that absolutely cratered the market on Friday was pretty concrete. President Trump had threatened to impose an additional, quite drastic, 100% tariff on Chinese goods starting November 1st.
100%.
100%. And critically, he also threatened export controls on any and all critical software.
Now, this wasn't out of the blue. Sources following the tensions noted this was, a direct response to China tightening its own rare earth export controls and slapping new port fees on U.S. ships.
So escalation just breeds more escalation, tit for tat.
But the de-escalation was just as abrupt, wasn't it? The market rebounded instantly when the president took to Truth Social, assuring followers that relations with China will all be fine, basically walking back the immediate threat.
Right. He specifically suggested that the November 1st deadline, which let's remember is less than 3 weeks away,
very close,
was an eternity. And that just instantly calmed nerves and triggered the strong Monday morning rebound in futures. It just shows us that sentiment isn't just sensitive, it's hyper-reactive to noise right now.
Yeah, hyper-reactive is a good word for it. But what's fascinating here, as you pointed out, is that while the U.S. market bounced on the hope of deal, Beijing's response wasn't exactly cooperative.
Not at all. CNBC detailed China's immediate defiant posture. They stated they are not afraid of a trade war. And they accused the U.S. of a textbook double standard for imposing new tariffs after China took what it sees as legitimate measures on rare earth exports.
So it's more than just tariffs.
Oh, absolutely. This suggests the conflict isn't just about tariffs. It's really a battle over who gets to dictate the rules of global trade going forward.
That raises a really critical point about long-term stability. If analysts like those at Nomura cited in various reports are correct, and this cycle of tension, escalation, and truce is the new normal for U.S.-China relations, what does that actually mean for corporate America?
Well,
are firms now forced to model 3 entirely different supply chain scenarios: peace, war, limited truce, every single quarter? That sounds like a strategic planning nightmare.
It absolutely is a nightmare, and the stakes are enormous. Morgan Stanley is warning, according to analysis we saw on Bloomberg, that the S&P 500 risks an 8% to 11% drop if these tensions aren't resolved before that November 1st deadline looms.
Wow, 8 to 11%.
Yeah. This isn't just some abstract threat to stock prices. It's systemic risk being introduced by pure political uncertainty.
And this uncertainty, it doesn't just stay confined to the Pacific, does it? We've seen significant, pretty tangible geopolitical spillovers hitting Europe's crucial supply chains. We definitely need to talk about the Netherlands. The government took what they called highly exceptional control of Nexperia, a Chinese-owned semiconductor maker.
This is a huge move. Monumental, really. The Dutch government invoked something called the Goods Availability Act. That's essentially a powerful mechanism designed to safeguard national interests and, crucially, critical knowledge.
Okay.
For listeners who maybe don't track EU policy that closely, invoking this act is almost like a soft nationalization, aimed squarely at protecting intellectual property.
So what was the specific justification? Was it espionage concerns or more economic risk?
Kind of both, in a way. CNBC reported the government cited recent and acute signals of serious governance shortcomings and actions within Nexperia. The move was specifically aimed at safeguarding crucial technological knowledge and capabilities, particularly for the Netherlands and Europe as a whole.
And the auto industry is key there.
The real concern here seems to be the automotive industry, yes.
Yeah.
It relies heavily on these specific capabilities, and you saw the market reaction when the announcement broke. Wingtech, which is Nexperia's Shanghai-listed parent company, saw its shares plunge 10%. That just shows the gravity of protecting these supply chain choke points.
Right, and if we connect this event in the Netherlands to the turmoil we're seeing elsewhere, like the budget issues in France or political instability punishing bonds in Japan and the UK, it really does suggest that political risk is demanding an ever higher premium globally.
It certainly looks that way.
Are we maybe at a point where political instability is truly eclipsing central bank policy as the key market driver?
We are seeing strong evidence pointing in that direction, as detailed in reports from Bloomberg. When we talk about an ever higher premium on sovereign debt, it basically means bondholders are saying, look, we think your government might default or get destabilized, so we need a much larger guaranteed return to even consider taking that risk.
A risk premium.
It's exactly. For decades, investors mostly focused on inflation and interest rates, right? Now they're looking hard at coalition stability, trade war rhetoric, national security acts like the one in the Netherlands. Political risk isn't just a side issue anymore. It feels like it's becoming the main calculation for many.
Okay, let's transition then from that global geopolitical risk picture to domestic financial health. Because planning is exactly what the biggest U.S. banks are doing right now as Q3 earnings season kicks off this week. It's crucial.
Very crucial week.
We've got the 6 biggest players reporting: JP Morgan Chase, Citigroup, Goldman Sachs, Wells Fargo, Bank of America, and Morgan Stanley.
And interestingly, the near-term narrative for these financial giants is actually surprisingly robust. Analysts, according to what we saw in Yahoo Finance, are expecting a solid 6% rise in overall profit for the banks.
6% is pretty solid. What's driving that?
It seems to be continued activity in investment banking and trading. Revenue in those specific areas is expected to climb for a 7th straight quarter. That's driven by these highly active markets and global M&A deal volume surging past $1 trillion.
Okay, but here's the contradiction that seems striking. If M&A volume is over $1 trillion and trading desks are humming along nicely,
Right.
why should we take the warnings from top bank CEOs so seriously? Yahoo Finance also reports that Jamie Dimon and David Solomon have both sounded major alarm bells. They're predicting a serious stock market correction in the next 12 to 24 months.
Yeah, that's the million-dollar question, isn't it?
Are they just managing expectations, or is the credit environment truly darkening behind that record deal flow?
Well, it's likely a bit of both, but I don't think we can just dismiss their anxiety. They're dealing with two big things the immediate Q3 numbers don't necessarily show. First, the impact of escalating trade and tax uncertainties, which directly affect long-term loan defaults. That's a slow burn. And second, the ongoing U.S. government shutdown. That's actually delaying crucial economic data releases. So they're kind of flying blind into Q4 in some ways. CEOs like Dimon and Solomon, they're looking past the current deal frenzy and trying to price in potential systemic shocks down the road.
Right, looking over the horizon. Let's shift gears to another heavy hitter sector, big oil. Oil prices did bounce back this morning on that easing China rhetoric. Brent crude advanced above $63 a barrel, as we saw reported in Yahoo Finance and Bloomberg. However, the longer-term outlook for the energy supermajors, Exxon, Shell, BP, the usual suspects, it looked challenging.
That's right. Those monster profits of 2022, remember when they collectively earned nearly $200 billion?
Hard to forget.
Yeah, well, those are definitely fading. CNBC details that the reason is simply a generally weaker crude price environment compared to 2 years ago. And this puts immense pressure on their balance sheets, specifically when it comes to shareholder returns.
Ah, the shareholder returns. So they're forced to confront some tough choices, as the reports put it, about how to keep those generous payouts going without the massive windfall profits.
Exactly. It's the classic dilemma.
Uh-huh.
Do you cut buybacks or do you cut dividends? Analysts following Energy Finance who spoke with CNBC note that trimming share buybacks is clearly the easiest option. They call buybacks the gravy. It's flexible.
Right.
But cutting the actual dividend that stable income promise investors rely on, that's like cutting the steak. A dividend cut would send shivers through Wall Street. So we're already seeing companies like BP and Total Energies announcing plans to adjust their buybacks downward, specifically to preserve their ability to maintain that critical dividend payout, at least for now.
Protecting the dividend at all costs, it seems. Okay, now let's pivot to the sector that arguably defines the long-term market trajectory. Technology, and specifically artificial intelligence. Despite all the geopolitical chaos and the financial warnings we've just discussed, that long-run upward march in stocks still seems structurally driven by AI infrastructure investment.
That fundamental truth seems pretty undeniable right now. I mean, just take TSMC, the world's largest AI chip manufacturer. Reports note they are expected to post a record 28% jump in third-quarter profit. A huge jump.
28%.
And this is purely driven by insatiable demand for AI chips and sustained infrastructure investments globally. This AI land grab, it feels like it's happening regardless of whether the U.S. imposes a 100% tariff on, say, sneakers or not.
But here's where we run into that inherent contradiction again, isn't it? That massive structurally driven rally is causing serious AI bubble dread. Policymakers are genuinely getting concerned. We saw central bankers and global policymakers, including the IMF managing director, Kristalina Georgieva, confronting the risk of a market crash in Washington just this week.
Yeah, according to Bloomberg, Georgieva specifically warned that current valuations are heading toward levels we saw during the dot-com bubble 25 years ago.
Oof, the dot-com comparison.
Exactly. She emphasized that a sharp correction in the AI sector could significantly drag down world growth. It's a stark reminder, really. While the underlying technology is clearly transformative, the valuation multiples, well, they might be getting dangerously disconnected from current reality.
And adding another layer of complexity in the consumer tech space, specifically EVs, we have a major safety event out of China. It directly challenges one of the industry's most popular, but maybe most vulnerable design trends.
You must be referring to the Xiaomi EV stock plunge.
Yeah, shares dropped significantly, up to 8.7%, I think, following a really tragic fatal crash in Chengdu involving one of their SU-7 electric sedans.
What happened there?
Well, while the police apparently suspect drunk driving was a factor, video footage circulated pretty widely showing the car caught fire after the crash. And crucially, the electronic door handles failed to open, apparently trapping the occupants inside. Oh, that's horrific. And the failure of those electronic door handles, that's the key point here, isn't it? Because it intensifies scrutiny on a design feature that was popularized by high-end manufacturers like Tesla, where, sensors and electricity replace the old mechanical linkages.
Precisely. And if you look at reports from both CNBC and Bloomberg, China is now reportedly considering banning these electronic door handles entirely. They're citing the demonstrated safety risks in the event of power loss or fire, like in this crash.
Wow.
This incident just shows the immense pressure on these consumer tech companies, right? They have to balance high-tech design, a feature consumers increasingly expect, against practical, immediate safety mandates from a powerful regulating government. This is a very tangible risk that can just wipe out billions in market cap instantly.
A stark reminder of real-world consequences. Before we move to our final takeaways, we should probably mention the single piece of, well, unreservedly good geopolitical news from the weekend. The U.S. brokered Israel-Hamas ceasefire resulted in the release of hostages.
Yes, definitely important positive news.
But economists were pretty quick to point out that the immediate economic impact of this is considered very limited, unless, of course, it leads to a much more dramatic, sustained calming of broader regional tensions and, critically, shipping disruptions.
Right. The follow-through is key there. So ultimately, looking back at everything, we've seen markets oscillate wildly based on single rhetorical statements. It just shows how fragile sentiment still remains.
Definitely fragile.
But beneath that surface chaos, the underlying structural themes, the AI-driven tech rally, the perhaps surprising resilience of banks' operational earnings, and those financial pressures facing big oil, they continue to evolve. But they're evolving under this deep, pervasive shadow of escalating and, frankly, unpredictable geopolitical risk.
So what does this all mean for you, our informed listener? I think the key takeaway is that the biggest threat isn't just the trade war itself, whether those specific tariffs hit or not, but the widening range of uncertainty it creates. That November 1st deadline is looming less than 3 weeks away, and corporations are being forced to price in these drastic triple-digit tariff scenarios, and that just forces capital decisions to freeze up, which, as you know, is poison for the economy.
It absolutely is. And that uncertainty leaves us with a truly provocative thought to ponder. If we combine those serious warnings from seasoned Wall Street CEOs like Jamie Dimon and David Solomon about a pending correction, alongside the IMF's crystal-clear comparison of current AI valuations to the disastrous 2000 dot-com bubble, well, how much true systemic risk is the current market actually pricing in beyond the immediate China volatility?
That's the question.
We're really left wondering if the impressive technical rebound we saw this morning is a genuine sign of market resilience,
Right.
or is it merely a temporary sort of rhetoric-fueled pause before the difficult couple of weeks that analysts seem to be unanimously predicting?
A deeply unsettling question for investors globally indeed. Thank you for joining us for this deep dive into the sources from Monday morning.
A pleasure as always.
We'll see you all tomorrow morning with new headlines from major financial magazines.